Let's jump right into it. Have you ever noticed how if you walk down the street, an Islamic bank and a conventional bank look exactly the same? I mean, you've got the tellers, the ATMs, the giant vaults, the whole shebang, but underneath it all, they are running on completely different financial engines. In this explainer, we're going to look way past the architecture and dive into the actual mechanical plumbing that makes these two systems run. So the big question is, what's the actual mechanical difference? Think about that engine metaphor for a second. One system works literally by churning out interest, while the other claims to run entirely on physical trade and profit. Now, that might just sound like a subtle shift in vocabulary, but it completely rewrites the DNA of every single transaction happening inside those walls. To really understand the future of global finance, we've got to pop the hood on both. Section 1, the mechanics of interest, the conventional status quo. All right, before we get into the alternative, let's quickly look at the baseline most of us use every single day. In the conventional model, the bank treats money itself as a product. The engine is super simple. They rent out cash and they charge you a fee for the time you hold onto it. And that fee, of course, is interest. It's the default setting for our modern global economy, turning capital into something that just continuously generates passive yield. The bank's main inventory isn't goods or services, it's literally just cash, waiting to be sent out for a guaranteed return. Here's how it works. You borrow cash, and eventually, you return that cash plus a little extra premium. Notice that this is purely a cash-to-cash transaction. Honestly, the bank doesn't really care about the physical car you're buying or whether your new startup succeeds. They only care that your debt obligation, plus that interest, is paid on schedule. The risk? Well, that falls heavily on you, the borrower, while the bank sits pretty comfortably as a shielded provider of liquidity. Section 2. The Islamic alternative, shifting the engine. Now, what happens when you remove interest from the equation completely? You are basically forced to build a radically different operational framework. This brings us to Riba, which is the Islamic term for interest. The entire Islamic banking system is built specifically to avoid riba. Why? Because in Islamic philosophy, money is just a tool for exchange. It's not a magical asset that should just breed more money without any underlying effort or physical trade. But wait, that raises a massive operational dilemma, right? If a bank can't charge you a premium just for handing over cash, how on earth do they survive as a profitable business? Well, since they can't rely on passive interest, Islamic banks use 4 active models: trade, profit sharing, rent, and partnerships. You'll often hear terms like murabaha for trade or musharaka for partnership. Instead of just passively sliding cash across a desk, the bank actually has to participate in the real economy. They have to physically buy assets, lease out equipment, or even take equity stakes right alongside business owners. Basically, the bank transforms from a passive lender of capital into an active commercial partner. Section 3, the car loan example, abstract to concrete. Okay, let's take these theoretical concepts and ground them in reality. Let's look at buying a car. If we compare them side by side, the conventional bank hands you cash, and you pay back that cash plus a fee. Their entire relationship is exclusively with the money. But the Islamic bank, they focus entirely on the physical asset, the actual car, rather than the cash used to buy it. Their transaction literally has to be anchored in the real, tangible world. So here is the step-by-step. Step 1, the Islamic bank actually goes out and buys the car from the dealership. Yep, for a brief moment, they legally own it and hold the physical liability for that vehicle. Step 2, they sell that exact car to you at a marked-up profit, which you usually pay off in installments over time. Now, you might be thinking, doesn't that make the bank act more like a car dealership? Actually, yes. They make their profit from a verified commercial trade, not from lending out money. The profit comes from moving a real product, not renting out currency. Section 4, core differences, lending versus risk sharing. And this brings us right to the foundational shift in how macroeconomic risk is handled. Look closely at this side-by-side chart. On the left, the conventional system's core mechanism is lending money, which means its risk model is inherently debt-focused. The risk falls almost entirely on the borrower to pay back the principal and interest no matter what happens to the asset itself. But on the right, Islamic banking relies on asset-backed trading. Because the bank actually has to own the asset or jump into an equity partnership to make a dime, the whole model pivots entirely to shared risk. If the asset gets destroyed before the transfer is complete, or if the partnered business goes under, the bank shares in that loss. On a massive macroeconomic scale, this creates a pretty amazing safeguard. It structurally limits toxic debt bubbles because every single financial transaction has to be directly tethered to a real, tangible asset in the real economy. Section 5, the foundational philosophy. So let's zoom out. Why does this alternative even exist, and what's driving its continued growth? The ultimate goal here is to conduct ethical business that aligns directly with religious principles. The system intentionally matches its financial mechanics with these specific beliefs. But honestly, it also offers a super compelling perspective for anyone interested in broader economics, regardless of your background. Think about it. What actually happens when a banking system is forced by its own rules to prioritize shared risk over guaranteed debt? It completely alters the relationship between capital, commercial markets, and the community. It forces the financier to have real skin in the game. Which leaves us with a totally fascinating, provocative question. We know riba means interest, and we know exactly how banks mechanically avoid it, but what is its deeper nature? Why is the simple act of charging a fee for a loan so strictly forbidden in Islamic philosophy? And what does that reveal about human behavior and economic justice? We'll be uncovering that exact question in our next explainer. Thanks for joining us.